Last month, Rightmove quietly removed over 40,000 property listings. Not sold, not withdrawn because the owners changed their minds, removed because they've been sitting there for so long it was starting to look embarrassing. Properties that just wouldn't move. Estate agents didn't want them visible anymore. They didn't want buyers scrolling through pages of stale listings that told a story they're desperate to hide. At the same time, estate agents across the country are being quietly encouraged to stop emphasizing real selling prices. Banks are sitting on repossession data they refuse to release. Mortgage lenders are tightening criteria without announcing it publicly. Everyone is pretending everything is fine, but it's not fine. The UK housing market is doing something I've never seen in over 20 years of watching property cycles. It's not crashing in a dramatic way, it's not correcting in a healthy way either. It's freezing, completely locking up. Buyers are waiting, sellers are waiting, lenders are waiting. Everyone is holding their breath, waiting for someone else to blink first. And when someone finally does blink, what happens next is not going to look like 2008. It's going to make 2008 look like a rehearsal.
I need to be honest with you. I've been tracking UK property for years, and something changed about 6 weeks ago. The mood shifted. Not in headlines, not on government dashboards, not in estate agent windows. It shifted quietly. The smart money started moving, slowly, carefully, but unmistakably. Property funds are cashing out, developers are halting projects mid-pipeline, build-to-rent operators are refinancing at punitive rates or failing to refinance at all. Even estate agents, the most relentlessly optimistic people in the entire economy, are starting to crack. Not publicly, never publicly, but get a few drinks into them and they'll tell you the truth. Things are getting strange. Deals are falling apart at the last minute. Buyers are disappearing after surveys. Valuations are coming in tens of thousands under asking. So everyone's asking the same question. Is the UK heading for a housing collapse? The answer isn't simple, because this isn't going to play out like previous crashes, where prices just fell off a cliff. This is slower, more complex, and potentially far more dangerous, because freezes break systems quietly before they break them loudly. Here's the problem nobody wants to talk about. Around 1.4 million UK households have fixed-rate mortgages expiring within the next 12 months. Another million will roll off the year after that. These people locked in deals at 2%, sometimes 2.5%. At the time, that looked sensible, conservative even. Now they're staring at rates closer to 5, 6, even 7%, depending on loan-to-value and lender appetite. Let's do the maths properly. A £300,000 mortgage at 2% costs roughly £1,100 a month. That same mortgage at 7% costs over £2,100 a month. That's an extra £1,000 every single month, not temporarily, but for decades.
Where is that money supposed to come from? Wages haven't gone up by £1,000 a month. Most people haven't had a real pay rise at all once inflation is factored in. Food costs are still high, energy bills remain elevated, council tax is rising, insurance costs are rising, everything is rising except income. So what happens? People try to sell. But here's the catch. Everyone else whose fixed rate is ending is trying to sell too, at the same time, into the same market, with the same problem. That's what's starting right now. I spoke to a mortgage broker recently who's been in the industry for over 30 years. He said he's never seen anything like this. People with clean credit histories, stable jobs, teachers, nurses, middle managers, people who did everything right, sitting across the desk from him while the affordability calculator simply says no. Not because they're reckless, not because they're over-leveraged, but because the rules no longer allow them to borrow enough to stay in their own homes. They're trapped. They can't afford the new payments, they can't remortgage, they can't sell because the market is saturated with sellers just like them. That's not a correction, that's a systemic affordability crisis. For 20 years, whenever the UK housing market looked shaky, foreign money rode to the rescue. Russian oligarchs, Chinese investors, Middle Eastern sovereign wealth funds, they saw dips as buying opportunities. That safety net is gone. Russian money has vanished under sanctions, Chinese overseas property investment has been effectively banned by Beijing, Middle Eastern capital is becoming far more selective, and when it looks at the UK, it doesn't see stability, it sees political dysfunction, weak growth, rising taxes and regulatory uncertainty. In 2019, foreign buyers accounted for roughly 30% of London property purchases above £1 million. In the most recent data, that figure has collapsed into single digits. That's not a slowdown, that's an exit. And it's worse than that. They're not just not buying, they're selling, quietly, discreetly, off-market when possible, portfolio by portfolio.
There are entire buildings in London where overseas funds own the majority of the flats. In some of those buildings, instructions have gone out to accept any offer above 60% of original purchase price. 40% losses willingly taken because those investors believe 50% losses are coming if they wait. When sophisticated international investors are prepared to crystallize losses of that magnitude just to get out, you should ask yourself what they're seeing that the average homeowner isn't. Then there's build to rent. This was supposed to save the housing market. Institutions borrowing billions at near zero interest rates to build sleek rental towers for young professionals who couldn't afford to buy. On paper, it looked perfect: stable income, professional management, long-term demand. In reality, it's breaking down fast. Occupancy rates in major build-to-rent schemes in cities like Manchester and Birmingham have fallen to around 50 to 60% in some developments. These buildings need close to 90% occupancy just to break even. The maths no longer works. Young professionals are leaving city centres. Some are moving back in with family. Some are leaving the UK altogether. Some are simply refusing to pay premium rents in half-empty tower blocks financed at yesterday's interest rates. So they bleed cash every month. At least one major operator is on the brink of defaulting on hundreds of millions of pounds in loans. When that happens, banks won't just be exposed to bad debt, they'll be left owning thousands of flats they can't rent profitably and can't sell at book value. That's when things start to unravel very quickly.
And then there's the leasehold scandal, which makes everything else look small by comparison. There are around 4 million leasehold properties in the UK. Most owners think they own their homes. They don't. They own a time-limited permission slip. Ground rents are doubling, service charges are tripling, major works bills of £20,000, £30,000, £50,000 are landing on doormats with no warning. And here's the killer: these properties are becoming unsellable. Buyers have finally realised that leasehold often means unlimited liability with no control. Mortgage lenders know it, surveyors know it, conveyancers know it, so transactions dry up. Flats that sold for £400,000 in 2017 are now being valued at £150,000, not because the area declined, but because the legal structure is toxic. In some developments, freeholders have announced remedial bills that exceed 20% of the property's value. Owners can't pay, they can't sell, they can't walk away because the liability follows them personally. That's millions of properties slowly turning into financial traps at the same time. No forecast model accounts for that. The Bank of England knows all of this, and they have an impossible problem. They need to keep interest rates high enough to control inflation, but high rates are destroying the housing market, and a destroyed housing market destroys consumer confidence, spending, and ultimately the entire economy. They talk about rate cuts to keep hope alive, but inflation isn't dead, it's dormant. Cut too fast and it comes roaring back, so they're stuck. Keep rates high and let housing implode, cut rates and let the currency and inflation implode. There is a third option, and it's the one they're quietly preparing for. Let the housing market crash, then step in to support the banking system again. But this time the public mood is different. The tolerance for bailouts is gone.
And there's another factor nobody wants to talk about: demographics. The UK has a collapsing birth rate. Household formation is slowing. The population is aging rapidly. Older people sell houses, they don't buy them. The baby boomer generation owns a huge proportion of UK housing stock. Over the next decade, millions of properties will hit the market as estates are settled. Who buys them? Not their children who are priced out, not investors who are exiting, not foreign buyers who've already left. At the same time, there are around 600,000 homes currently under construction that will complete within the next 2 years. They'll come onto a market where affordability is broken and demand is shrinking. Developers already know this. That's why bulk discounts of 30 to 40% are being quietly offered behind closed doors. That alone tells you everything you need to know about where real prices are heading. UK banks hold roughly £2 trillion in mortgage debt. If property prices fall 20%, that's £400 billion of value wiped out. And that's assuming an orderly market. But this isn't orderly. This is a stampede waiting to happen. When everyone needs to sell at once, prices don't fall gently. They fall until someone, anyone, is willing to buy. Internal risk scenarios at major banks are already modelling 50% price declines in certain regions. They won't say it publicly because saying it would make it real. The government knows this too. They're paralysed. Every policy lever makes things worse. Cut stamp duty and you pull forward demand, deepening the crash later. Build more homes and you flood an already oversupplied market. Restrict foreign buyers and you remove the only remaining capital. Help to Buy just creates debt that can't be serviced.
They're out of moves. Every crash needs a trigger. In 2008, it was Lehman Brothers. This time, it could be a major developer collapse, a bank admitting mortgage losses, or simply one credible voice saying out loud what everyone already knows, that UK property is massively overvalued relative to incomes and the correction is unavoidable. When it happens, it won't take years, it will take months, maybe weeks, because panic now spreads at the speed of a viral clip, a leaked memo, a single careless comment. So are we heading for a housing collapse? No, we're already in it. It's just happening quietly, hidden behind frozen listings, creative accounting, and denial. The smart money has gone, foreign investors have left, developers know it's over, estate agents are starting to crack. The only people who don't know yet are ordinary homeowners, and they're about to find out. This isn't fear-mongering, it's arithmetic. When half the country can't afford their mortgages, when foreign capital disappears, when millions of properties become unsellable, when banks prepare for 50% falls, that's not a correction, that's a collapse. The only question left is whether you'll be ready when reality finally stops being delayed.